Okay, I want you to think about someone specific right now. You went to the same college, maybe even graduated the same year, you both got jobs around the same time, similar companies, similar salaries, you've both been working for what, 5, 6, 7 years now? And somehow, they just bought a flat. Not rented, bought. And they're talking about their mutual fund portfolio crossing 25 lakh rupees. And you're sitting there thinking, but we literally earn the same money. How is this happening? That moment, that specific confusion is exactly why I made this video. My name is Rohan, and I spend way too much time thinking about why people with identical salaries end up in completely different financial realities. If you're someone who feels like you're working hard, earning decent money, but somehow never getting ahead, never building real wealth, never feeling financially secure, make sure you hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we are going deep on the thing nobody talks about. It's not about how much you earn, it's about what happens to money after it enters your account. Let's start with some numbers, real numbers, 2026 numbers. The average salary for a mid-level professional in India right now, someone with 5 to 8 years of experience in IT, finance, marketing, is somewhere between 12 to 18 lakh rupees per annum. Under the new tax regime for FY 2025-2026, once you factor in the zero tax slab up to 12 lakh rupees, the standard deduction and employer PF, that works out to roughly 90,000 to 1,25,000 rupees in hand per month. Now here's a stat that genuinely surprised me. According to SEBI's January 2026 data, exactly 9.5% of Indian households are investing in the securities market. And when you narrow it down to sustained regular investing, SIPs maintained for 3 years or more, we are probably talking well under 5%. 5% in a country of 1.4 billion people with a booming middle class and one of the fastest growing economies in the world, barely anyone is systematically building wealth. And yes, AMFI just reported SIP inflows crossing 31,000 crore rupees a month as of early 2026, which sounds incredible. But zoom out and it's still a tiny fraction of the earning population actually doing this consistently. So, where is everyone else's money going? Here's what the average Indian urban professional in the 12 to 18 lakh rupees per annum bracket spends their money on, approximately. Rent 20,000 to 35,000 rupees per month, 30 to 35% of take home. EMIs, phone, laptop, car, 8,000 to 15,000 rupees per month. Food and dining out, 12,000 to 18,000 rupees per month. Subscriptions and entertainment, 3,000 to 6,000 rupees per month. Clothing and lifestyle, 5,000 to 10,000 rupees per month. Travel and weekends, 5,000 to 8,000 rupees per month. Add that up, and I haven't even listed utilities, transport, medical, or insurance, and you can see exactly why the savings account stays thin. There's always something eating the remainder. Okay, let me introduce you to two people. They're fictional, but I promise you, you know both of them in real life. Arjun and Vikram. Same engineering college, same batch, both got placed in good companies. By 2026, both are earning 1,20,000 rupees in hand per month. Arjun is the fun one. Great guy, honestly. He's got the latest iPhone, the 17 Pro, which is roughly 1,30,000 to 1,50,000 rupees. He drives a Creta on a 7-year loan. That's a 12 to 15 lakh rupees outstanding principal, not a small number. He goes to Goa twice a year because, man, you only live once. He eats out 4 times a week, and he's got about 1,10,000 rupees sitting on a credit card at 36 to 42% annual interest. Vikram is a little different. He uses a 2-year-old phone, he takes the metro on weekdays, he cooks most nights, he doesn't post much on Instagram. But here's the thing people get wrong about Vikram. He's not a martyr. He owns a Honda CB 350 RS, fully paid off. No EMI, no debt. On weekends, he takes it on highway runs up to Lonavala or Coorg. He enjoys his life. He just made a deliberate decision. Own your assets rather than let your assets own you. He drives something he paid for. Arjun drives something that owns him for the next 5 years. Now, here's what's actually happening with their money. Arjun saves roughly 8,000 rupees a month. On a good month, he's got maybe 2 lakh rupees in a savings account. He thinks he's doing okay because he's not that much in debt. Except that credit card interest alone is costing him close to 40,000 rupees a year. He's effectively running backwards without realizing it. Vikram, selectively frugal, invests 30,000 rupees a month. He started SIPs at 24. He has an emergency fund parked in a liquid fund, and by age 29, his mutual fund portfolio has crossed approximately 25 lakh rupees. Same salary, same city, 5 years, one has 2 lakh rupees in a savings account, the other has 25 lakh rupees in a growing portfolio. How? Here's what most people don't realize. When I tell this story, people always say, oh, Vikram is just more disciplined. And I'm going to push back on that really hard because that framing is actually part of the problem. Discipline is a finite resource. Willpower runs out. If Vikram was relying purely on discipline, gritting his teeth every month and forcing himself not to spend, he would have broken by year 2. Everyone does. The difference between Arjun and Vikram is not character, it is systems. Vikram automated his investments before his salary hit his spending account. He set up a separate bank account. His SIP date is the 2nd of every month, the same day his salary hits. The money is gone before his brain can come up with reasons to spend it. This is called paying yourself first, and it costs you literally nothing except a 20-minute setup on a Monday afternoon. Arjun, on the other hand, tries to save what's left at the end of the month. And here's the brutal truth about that approach. There is never anything left at the end of the month. Lifestyle always expands to fill available money. This is Parkinson's law applied to personal finance, and it is working against you every single day until you design around it. Now let's talk about something that genuinely makes me frustrated, because I feel like nobody explains this clearly. Arjun has 2 lakh rupees sitting in his HDFC savings account. He thinks this is responsible. At least I have savings, he tells himself. Here's what's actually happening. His savings account gives him 3 to 3.5% annual interest. India's retail CPI inflation as of early 2026, based on the revised 2024 base series from MOSPI, is running at approximately 3%. So after inflation, Arjun's savings account is giving him a real return of roughly 0.5%. Add in the taxes he owes on that interest income, and he's quite literally stagnating. In 5 years, his 2 lakh rupees will nominally say roughly 2 lakh 5,000 rupees. He hasn't lost money, but he has completely lost time. And he has zero chance of building wealth on a 3.5% nominal return when diversified equity index funds have been compounding at over 11% annually. Now compare that to Vikram, whose SIP portfolio invested in a Nifty 50 index fund has grown at approximately 11.8% CAGR over the last 5 years. That's the actual number if you track the Nifty 50 from January 2021 to March 2026. Not a rounded-up optimistic figure, the real lived-through one, including the dip in 2022. The gap isn't just 11.8% versus 3%. After inflation, it's about 9% in real returns versus near zero. Every year, compounded. This is where it gets really interesting. Let's run the actual numbers. Vikram's 30,000 rupees per month SIP started at age 24, invested in a diversified index fund at 11.8% CAGR. At age 29, 5 years, approximately 24.6 lakh rupees. At age 30, 6 years, approximately 31.5 lakh rupees. At age 35, 11 years, approximately 81.3 lakh rupees. At age 40, 16 years, 1.71 crore rupees. At age 45, 21 years, 3.32 crore rupees. Arjun's 8,000 rupees per month deposits at 3.5% in a savings account. At age 30, 6 years, approximately 6.4 lakh rupees. At age 35, 11 years, approximately 13 lakh rupees. At age 40, 16 years, approximately 21 lakh rupees. At age 45, 21 years, 30 lakh rupees. Same salary, same city. One ends at 3.32 crore rupees, the other ends at 30 lakh rupees. And remember, Arjun's 30 lakh rupees hasn't accounted for the years he was paying 36% interest on credit card debt. That is a 3.02 crore rupees difference created entirely by habits, systems and compounding, not income. Now you might be thinking, okay Rohan, but Arjun is actually enjoying his life. Goa trips, nice car, good food. Vikram sounds miserable. And look, I hear you. This is the most common objection, and it's also the most dangerous one because it's partially correct. You should absolutely enjoy your money. A life of pure deprivation in pursuit of some number on a screen is not a goal worth chasing. I am not here to tell you to eat Maggie every night and never travel. Here's the thing though.
Arjun isn't actually enjoying freedom. He's enjoying the illusion of freedom. His car EMI means he has to keep his job. He can't negotiate his salary aggressively. He can't take a calculated risk on a startup. He can't take 3 months off to figure out what he actually wants to do. His spending has removed optionality from his life. But Vikram, on the other hand, by 34 with 60 plus lakh rupees in his portfolio, he has what I call FU money, a financial cushion that lets him make decisions from a position of strength, not desperation. He can walk out of a toxic workplace, he can take 6 months to start a business, he can say no to a promotion that would ruin his mental health. That is the real product you're buying when you invest, not just rupees, options. Alright, let's go a little deeper because math alone won't save you. You need to understand the psychology working against you. Trap number 1, lifestyle creep. Every time your salary increases, your lifestyle silently expands to match. You get a 20% hike, congratulations. And then 3 months later, you've upgraded your apartment, bought a better bike, and somehow your food budget is 40% higher. Net change in savings? Zero. The fix? When you get a raise, increase your SIP first, before you upgrade anything. Move at least 50% of the post-tax increment straight into investments. You won't even notice it's gone in 2 months, but your future self will notice it in 20 years. Trap number 2, relative consumption. This one is sneaky. You don't compare yourself to the average Indian. You compare yourself to your WhatsApp group. Your reference group is all earning 12 to 20 lakh rupees. So when someone in your group buys a car, you feel behind. When someone goes to Thailand, you start planning a trip. But here's the math reality. Most of your WhatsApp group is also financially behind. They just look wealthy. There's a difference. The average urban Indian in their late 20s has under 4 to 5 lakh rupees in actual investable financial assets, most of it in gold or fixed deposits, per RBI household finance data from FY25. That brand new Creta and the Thailand trip are often financed by EMIs, credit card debt, or parent support, not real wealth. Stop benchmarking your lifestyle against other people's visible consumption. Start benchmarking your balance sheet against where it needs to be. Trap number 3, the emergency that isn't. I was going to invest this month, but my cousin's wedding came up. I was going to start an SIP, but my phone broke. The market is too high right now. I'll wait. These are not emergencies. These are excuses dressed up as emergencies. A genuine financial emergency is job loss, a medical crisis, a family disaster. Those require an emergency fund, which is 3 to 6 months of expenses in a liquid fund or high-yield savings account. For most of you reading this, that's roughly 2 to 4 lakh rupees. Build that first. Once that exists, every emergency gets paid from there, and your investments stay untouched.
Okay, enough theory. Here is exactly what to do in order starting this week. Step 1. Know your number. Open your last 3 months of bank statements right now. Calculate what you actually spend on each category. Most people are genuinely shocked by this exercise. I've had people realize they're spending 12,000 rupees a month on Swiggy. Not judging, just knowing. Step 2. Kill the high interest debt first. If you have credit card debt at 36 to 42% interest, this is your absolute priority. You cannot out-invest 36% interest. No SIP in the world compounds faster than what you're losing on revolving credit card balances. Pay this off aggressively, then redirect that cash into investments. Step 3. Build the emergency fund. Target 3 to 6 months of expenses in a liquid mutual fund, something like Parag Parekh Liquid Fund or HDFC Liquid Fund. These give you roughly 6.2 to 6.7% returns versus 3 to 3.5% in a savings account, and you can redeem in one business day. Now, and this is important, building this fund will realistically take 9 to 12 months, not 90 days. If your bare bones monthly expenses are 80,000 rupees, a 3-month fund is 2,40,000 rupees. You cannot save 2,40,000 rupees in 90 days without destroying your living situation. Don't rush it. Set a fixed monthly auto debit into a liquid fund, even 10 to 15,000 rupees a month, and let it accumulate steadily. The goal is to build it, not to build it fast at the cost of everything else. Step 4. Automate wealth building. Set up an SIP on the second of every month, the day after or day of your salary credit. Start with whatever you can, even 5,000 rupees. For index funds, the Nifty 50 index funds from UTI or HDFC are solid starting points. Low expense ratio, massive diversification, zero fund manager risk. As a rough target,
20% of take-home salary into investments. If you make 1,20,000 rupees in hand, that's 24,000 rupees per month. 15,000 rupees into a Nifty 50 index fund SIP, 5,000 rupees into a mid-cap or flexi-cap fund, 4,000 rupees into PPF for tax saving and long-term stability. PPF gives you 7.1% tax-free, genuinely underrated. That's your foundation. One important note, and I want to be upfront about this because most finance content ignores it. Equity mutual fund gains above 1,25,000 rupees per year are taxed at 12.5% LTCG, a rule that's been in place since the 2024 tax changes. This doesn't change the math dramatically, but it does mean your actual take home from Vikram style investing will be slightly lower than the nominal portfolio value. Factor that in. It's still wildly better than a savings account. Just don't be surprised when you redeem. Step 5. Increase income deliberately. This is the thing most personal finance people don't want to say because it feels uncomfortable. Frugality alone has limits. You can only cut so much. The bigger lever is income. Upskill, negotiate your salary, build a side income. The India Skills Report 2025-26 shows that professionals with certifications in AI, data analysis, cloud computing, and product management are commanding 30 to 40% premium salaries over peers with identical years of experience. That skill gap is an income gap, and an income gap invested correctly is a wealth gap. Here's what I want to leave you with. The story of Arjun and Vikram, it's not a story about intelligence. It's not about privilege or luck or having rich parents. Both of them started from the same place. It's a story about defaults. Arjun spent money by default and saved what was left. Vikram invested by default and spent what was left. That one reversal, that one tiny structural decision created a 3.02 crore rupees difference over 20 years. The scary thing? Most people are Arjun, not because they're careless or irresponsible, but because nobody ever sat them down and showed them the math. Nobody modeled it for them. Nobody built the system with them. You can change your default starting today. Not next month when your hike comes through, not after you pay off that one thing. Today. Open Zerodha Coin or Grow or HDFC Mutual Fund, whatever you're comfortable with, and set up a 500 rupee SIP if that's what you can do right now. The amount matters less than the habit. The best time to plant a tree was 20 years ago. The second best time is right now. I'll see you in the next one.